To many people, the global economy feels like an incomprehensible beast. We watch markets swing and panic during crashes, often suffering because the underlying movements seem completely unpredictable. Investor Ray Dalio views it differently. After decades of navigating these markets, he argues that the economy is actually a simple mechanical engine driven by basic human nature. By dismantling this machine into its most basic parts, we can see the logic behind the chaos. We can track how individual pieces interact and identify the patterns that lead to the next crash. Breaking the machine down into these components makes it possible to anticipate a crisis based on the specific interactions that precede it. The smallest moving part of this entire engine is a single transaction. It happens every time a buyer exchanges money or credit with a seller for goods, services, or financial assets. Transactions follow a fixed rule. One person's spending is always another person's income. Every dollar you spend is a dollar someone else earns. This chart tracks that loop. When your income rises, lenders view you as more creditworthy and become more willing to lend you money. That credit allows you to spend more, which in turn becomes higher income for the next person in the chain. As this pattern repeats, the economy expands. This self-reinforcing cycle of borrowing and spending is the primary mechanism behind economic growth. But there is a hidden reality in this cycle. The vast majority of what we call money in these transactions isn't actually cash, it's credit. This chart shows the scale of that gap. In the United States, there is roughly $50 trillion of credit, while the total amount of physical money is only about $3 trillion. Relying on credit allows us to spend more than we produce in the short term, but it also makes the system inherently volatile. It sets the stage for the massive swings between booms and busts. To understand those swings, we have to look at what borrowing actually is, a way of pulling spending forward from your future self. When you borrow to buy something you can't afford, you are essentially creating a time in the future where you must spend less than you earn to pay it back. You have effectively created a cycle. When this happens across the entire economy, it creates the short-term debt cycle. This is a 5 to 8 year wave of expansion fueled by easily available credit. The central bank, the Federal Reserve, acts as the primary controller of this cycle. It manages the flow of credit by manipulating interest rates. By raising interest rates, the bank makes debt expensive and slows down the economy. By lowering them, it makes borrowing cheap and stimulates a recovery. While the central bank can manage these smaller waves, human nature ensures that a much larger problem is compounding quietly beneath the surface. Most people have a natural inclination to borrow and spend more rather than paying down their existing debts. We tend to focus on the immediate boom and ignore the long-term cost. Over several decades, this behavior causes debt burdens to grow faster than incomes. This creates a massive financial bubble where asset prices soar on the back of borrowed money. The long-term debt cycle hits its breaking point when debt repayments finally eclipse incomes. At this moment, spending stops abruptly. A chain reaction follows. As spending stops, incomes crash. Borrowers lose their creditworthiness, asset prices plummet, and the entire system begins to feed on itself in reverse. This is a deleveraging, and it differs from a standard recession because the central bank is powerless to stop it. Interest rates are already at zero, so they can no longer be used to stimulate the economy. The consequences are severe. During the crashes of 1929, seen here, and 2008, credit disappeared, banks were squeezed, and social tensions rose as the economy contracted. Borrowing more than we produce eventually forces this mechanical correction, a painful, system-wide reckoning where debts must finally be settled. To fix the machine, the total debt burden must come down. This requires policymakers to pull 4 specific levers. 3 of these levers are deflationary and painful: cutting spending, defaulting on debts, and redistributing wealth from the haves to the have-nots. These measures often lead to social disorder. When economic desperation is high, it can trigger radical political shifts, like in 1930s Europe. To counter these painful forces, the central bank uses the 4th lever, printing new money. This money is used to buy government bonds and financial assets, providing an inflationary stimulus. However, printing too much money creates the risk of hyperinflation. In 1920s Germany, currency became so worthless that children used it as building blocks. A beautiful deleveraging happens only when policymakers perfectly balance these deflationary and inflationary forces. This balance allows debts to decline while incomes finally begin to grow again. Protecting yourself in this machine comes down to 3 rules. First, do not let debt rise faster than your income, or the burden will eventually crush you. Second, do not let your income rise faster than your productivity, or you will eventually become uncompetitive in the global market. Third, do everything possible to raise your productivity. In the long run, your ability to produce is the only variable that truly determines your living standards. This template provides a way to read the global economy and anticipate its next major movements. With this mechanical view, you can navigate the system and better prepare for what comes next.